the lack of financing, but also the depression in values was very daunting for many funds. But it looks like everybody's expecting that we're off the bottom and things are looking a lot better for everybody. So how does all that impact real estate pricing? Well, we're now officially, the sign shows, we hit the bottom, we're off the bottom. Low interest rates, expanded availability of debt, and secure cash flows have definitely fueled demand for real estate in recent months. So strong investor demand in the core assets in the gateway markets has produced a huge rebound. And of course, we are looking beyond core in order to make the returns make sense. We can't continue to buy things at 4 cap rates. For many of the funds, that is not accretive. So you have to start looking at secondary markets and taking a little risk, and that's what's happening. So on the broader real estate market, we're showing that overall asset pricing has been uneven. Non-core assets and properties in smaller cities generally have not seen the pricing momentum we've seen in the core markets. As a property type, apartments, and everybody hears about this, it's actually at the top of every banner you're hearing about in the industry, apartments have been generally an exception. Thanks to the improving occupancy, the expectation in rent growth, the realized rent growth so far, and the stability of income. But personally, being that as a national investor, we get to look at a lot of different markets, we've shown that apartments aren't generally being the ones that are getting the sub-5 cap rates. There are truly differentiations being made by investors between urban and suburban, primary and non-primary MSAs. And while rent growth is showing up in most places, you're not hearing the 10 and 12% rent growth projections in many markets that you're hearing in the primary markets. So what we're expecting is that we bumped along the bottom for a little bit, but we're definitely seeing some improvement across the board, but it's pretty uneven. You got to pick your spots. So improving fundamentals across the sectors, definitely something everybody is looking at. Vacancy first has started to decline in property types with short-term leases, and that's apartments, storage, and hotels. With the renewed job growth and job growth projections and increasing retail sales, vacancies are stabilized in office. And even in Chicago, the place that seems to always be able to find a place to build a 1 million square foot building, we're seeing vacancy drop in the urban core, which is a great sign for us. It also means that somebody will probably start another 1 million square foot building sooner than later. But we've now seen those vacancies stabilize in the retail and warehouse sectors as of the second half of 2010. So healthy to strong demand growth coupled with limited supply should bode well for extended periods of rising occupancy, rents, and income across all property sectors. So then you talk about what's the other side of the coin. Many property markets are looking at questions about how cap rates can stay so low with the expected pressure on interest rates. So it is expected that the short-term rates are going to rise at least over the midterm. And that with the 10-year Treasury having bumped up and bumps down, bumps up and bumps down, also putting pressure on banks to narrow spreads in order to keep the money going out the door, we're still expecting that there is going to be an impact on cap rates in the near term in most property types. One thing that's doing is also fueling a lot of transactions. A lot of people are thinking that now's the time to sell. I don't know if it bodes well for people that are buying, but now's the time to sell while interest rates are relatively low, financing is relatively available, and those people who are looking to buy are going, well, if I can lock in my interest rate now, that will help me withstand the issues of rising interest rates over the midterm. So then you have transaction volume. And transaction volume in 2010, as I said, it was definitely higher than 2009. It's actually pretty close to the numbers of 2003. And for those of us who've been in the markets a long time, 2003, 2004, 2005, those numbers all kind of made sense to everybody. It's when things got really crazy in 2006, you started to wonder, you scratched your head going, can this be real? So the fourth quarter 2010 transaction volume was higher than previous quarters. First quarter 2011 is higher than it was in first quarter 2010. And so we're expecting that with the narrowing of the bid-ask spread and with the lack of product on the market, there will still continue to be some growth in activity. For myself, I talk to our funds at the beginning of every year, and I go, so what are you guys thinking about selling? And they scratched their heads, and they said, you know, we're going to sell a little suburban apartments because we don't really want to own those anymore. Oh, okay. We're not going to sell much office because we really don't think outside of Manhattan and New York anybody's really buying office. We sold all the industrial we were going to do last year, so probably won't do that. And you know, retail, we want the necessity retail, so we're not going to sell that, but we're going to try to sell lifestyle centers. Oh yeah, right. So we now have gone through the first quarter, and virtually every fund is revisiting its plans. With the total lack of activity in the market and buyers basically calling you, wanting to get deals off market. If it's a good asset, they would prefer to get it off market, so of course the competitive pressures in pricing don't impact them as much. And as an institutional seller, there's no way I'm going to do an off-market deal because I want the competitive pressures to actually help my pricing. The funds are starting to go, I think we're going to sell a little bit more. And we need to do that in order to take advantage of this current interest rate environment and the amount of capital that's looking to be placed. So volume has been heightened by the increased availability of debt, combined with all the equity in the market. Traditional lenders, along with the resurgence of the CMBS market, are going to help fuel the activity, and that we think that that will continue to support the lower pricing in the midterm. So as you'll see, if you look at kind of the up and down here, in 2009, that was 89% off the peak of 2007. 2010 was up 125% from the bottom. And 2011 is expected to wind up at about the 2003 number, which is about $200 billion. The top markets in 2010 were the ones you would expect. Your Manhattan, LA, Chicago, and DC. Chicago was the low-cost provider in that. Definitely not one, it's a great market, but many people do question the fact that it can always seem to develop. In 2010, 18% of all the sales were distressed sales. And as you can remember, a lot of the talk coming into 2010 was that the banks were going to suddenly start just unloading all of their distressed assets. There was plenty of money raised to actually capture that, and it didn't happen. So at the end of the year, though, as banks were looking at trying to clean up their balance sheet going into 2011, there were a lot more sales that actually happened. So of the 18% of the total volume being distressed sales throughout the year, a quarter of that happened in the fourth quarter, as people finally decided to move some things out the door. Right now, I think most brokers would tell you, while they're expecting a bit more activity from the servicers and the banks this year, the onslaught of distressed product is not going to happen. The rebound in values provided and supported by the reduced interest rates and the availability of equity to recapitalize deals is allowing banks to actually pick and choose what they're going to bring to the market. And most of it is not going to be the quality product that a lot of the investors and the funds were expecting. So, in conclusion, what do you say? Debt markets are active. Origination levels are lower because there haven't been as many trades. But the lenders are absolutely back in the market. So I was talking to a young woman here who is actually a guest. She's from BB&T. She's talking about the fact that, you know, their CRE teams are basically putting out money. I think virtually every lender in the room can say they're expanding their footprint in order to get money out into real estate right now. And of course, the cost of debt is incredibly appealing right now, and so everybody's trying to take advantage of that. CMBS is expected to issue $60 billion worth of paper this year. And that, looking at their $11 billion in 2010, and they've done $11 billion in the first quarter of 2011, CMBS is back strong, and that's going to be the piece that everybody feared we wouldn't have that's going to help really save the real estate industry in 2011 and 2012. For pension funds investing in real estate, the group as a whole has seen its allocations drop from the peak of 2008, therefore meaning they have a ton of cash that they have to get out the door. And for pension fund advisors like Prudential Real Estate Investors, Reef, Heitman, all of us who do this for a living, in an 18-month window, we went from having a queue to get out to having a queue to get in. Having a queue to get in, whoa, hey, you know, we were busy trying to figure out how to deal with these redemptions, and now we have money to invest, and with the lack of activity combined with the pricing in some of these markets, we're struggling with that. But what it means is that we're all back in the market big time in 2011. Additionally, the private REITs have sailed through this. They have continued to raise money hand over fist, quarter after quarter. And the fact that the moment the money hits their bank, it starts earning a return, that will continue to fuel their activity in the markets because they've got to get the money out virtually as soon as it comes in the door. So for PREI and its peers, it means that while we're back, what are we looking to buy? Many of us have core money, but we talked about how incredibly aggressive core pricing is. So we're struggling with getting that money out. We're looking at the value add. We're looking to develop. We're looking to capitalize developers again. We said we'd never do that again, but we found a way to restructure the deals, and we're going to do it hopefully on a risk-adjusted basis with the right sponsors, and sponsors are going to be really key this time around. I think they were before at the beginning, but in the rush to get money out the door, that sponsor thing got a little fuzzy around the edges. So we're looking at both existing and to-be-developed product, focus on apartments. We're building them, can't buy them. Necessity retail, that's grocery anchored, predominantly, the predominant grocer in the market is going to be the property type that we're looking for. High yield debt, I'm not quite sure what that looks like. It's not 18% anymore. It might be more like 12. And we're going to do maybe a hotel, maybe some industrial. The hotel markets have come back incredibly strong. With corporate profits, people are traveling again, like me. And so people are, the room rates are going up. Manhattan right now, it is almost impossible to get a room during the week at less than $500, $600 a night, and that's a mid-tier hotel. So we're also looking at growth markets and primary MSAs. Many of us went back to our clients in 2009 and said, we made a mistake. We traveled a little too far off the reservation. Core is core. Core is stabilized. Core is major market. Core is Class A. Core is not Milwaukee, at least not for us. But we are trying to be open-minded to the growth markets. Many growth markets are not identified as primary MSAs. And as long as they have the right drivers and some supply constraints, we'll start to venture more into those markets too. So for us and for many of our peers, the numbers are billions of dollars to be invested this year. If there's someone in this room that can help us invest some of our money in Tampa, please let our team in Atlanta know. We've always liked Florida and have always had a fairly good presence here, predominantly in the multi-housing and retail sectors. We do own a fairly large office building in downtown Tampa and a couple of office buildings in South Florida. But our guys like the growth story for Florida, and we will continue to look very strongly here. So please keep us in mind. So now the commercial. For many of you in the room who are longtime Crew Tampa Bay members, there still may be something here you don't know. For those of you who are not Crew Tampa Bay members, there may be something I know you don't know. And for people who are thinking about joining, maybe there's something that pushes you to do that. I obviously believe very strongly in the story of Crew Network. I think that it has a place in your professional quiver of organizations to be a part of because everyone kind of serves a different purpose. But for Crew, we've got 8,000 members, 74 chapters in North America. We do have a number of at-large members who are located in markets where we don't have chapters. We're probably going to go global in a couple of years, but that's got to be done with a little bit of consideration and a big bank account. But we see ourselves as not just an opportunity to provide networking, but an opportunity to help our members have the resources and information contacts to help them do what they do well, and to provide value to both their businesses if they're entrepreneurs or to their employers' businesses if they're employed by others. It's a lot more than just the people in the room. It's the 7,000 or 8,000 other people stretched throughout the United States that may have an expertise you don't have a contact you don't have, or be able to give you a perspective that you may need about how to do something a little different. So while I love my home chapter, Crew Chicago, been there for 15 years, what I really like most about Crew Network is the fact that I can send an email to anybody in the network, say, this is my problem, can you help me? Can you send me to somebody? Do you know this person? And within maybe 15 minutes, but no more than 24 hours, I've got the contact, the resource, the information that I need. And to me, that's invaluable and definitely worth far more than the dues that I pay. So we think that one of the things that it's important that we do is that we help work for our members. And so we've created CrewBiz CrewBiz is a closed-loop LinkedIn. And as many of you know who are on LinkedIn, it's really only as good as the information you put in it. So if someone's looking for you, if there's a keyword you can put in your bio that says, this is what I do, this is what I'm about, having that information in CrewBiz allows every other crew member to find you and to potentially bring you business or to just be a contact for you in another market. While real estate is local, contacts are global. And being in CrewBiz allows you to take advantage of that. And it's a way to market yourself. We do have recruiters that are in the organization that look at CrewBiz when they're looking for potential employees. Or if you're looking for an appraiser, or you're looking for an environmental firm or whatever, a lot of us really want to look for crew members first. So if you're there, you can be part of that. Our new website's up. After a couple of years of hard work and a lot of frustration, we've got our new website. I hope you'll visit it. For people who are not members of Crew, you can still go to the website. There's still a lot of information there that you can access without getting into the member side of the website. But there's great information there. We have a lot of just current market news. There's an opportunity to put your networking story up there. If you've done a deal with someone, if you've had someone's given you some help that you think is worth talking about as a crew member, we hope that you will do that. We have a deal room. You can actually put a deal out there if you've actually got space you need to lease, or you've done a deal you want to talk about. It's a way to do that too. We're on Facebook. You know, I really fought this Facebook thing. Probably if you went out and you looked at my Facebook page, you'd be really disappointed. I don't think there's really anything there. I think there's a wall that somebody put said happy birthday like last year on it. I might have responded to it. It's just, but as an organization, you know, we have a very broad demographic footprint now. Whereas when we started, we were all about the same age, and that was a long time ago. We now have many, many members who are very much into the social media way of networking. So we decided that we had to join the group. Take a look at our Facebook page. Tell us that you like us. Don't tell us if you don't like us. There's also great information occasionally when we're out trying to solicit information about scholarships or things like that. We do put it on our Facebook page. So take a look at our Facebook page. We have definitely moved into the 21st century. As I talked to the board last night, I told them, you know, I'm really a big proponent of what our Crew Foundation does. While it started out as a very broad-based philanthropic sidearm for Crew Network, right now it is something that is really very much in lockstep with what we're about, which is advancing the success of women in this industry. And what we do through the network, through our career outreach, is hopefully provide support for women who are having challenges with our mentoring program. It allows us to have our chapters work with Crew Careers or U-Crew, which is a way that we help build the pipeline of talent into the industry. And then we have our scholarship program, which we started 3 years ago through a sudden request. Our benefactor basically came our way and dropped about $400,000 in our lap and said, you know, we want you to do a scholarship program. And we went, ooh, okay, let's try this. In about 3 months, we got this up and running, and we have been so overwhelmed by the quality of the undergrad talent we have seen, of women saying they want to be in commercial real estate and they are pursuing careers to get them there, that we decided that we needed to perpetuate this support. So we're nearing the end of our $400,000 grant, but we are still raising money to hopefully have an endowment that will allow us to do this forever. We've had a couple of great pieces of news come about for some parties that are going to help us do this, which we'll announce in Las Vegas. But really think that this is a way that Crew Foundation can really bring home the mission of Crew Network, which is to support the success of women in this industry. So just as a last thing, a couple of things to put on your calendar. Our 2011 Leadership Summit in Las Vegas is open to every member of Crew. No matter if you are a delegate or a leader in your chapter, you can come. And for many of our members, it actually is a great way to get kind of a mini convention. It's less expensive. You're only there for a couple of days, and the registration fee, I think, is $150. But you still get the benefit of interfacing with women throughout the organization. And we always have some great professional or leadership development session. This time we're going to be talking about networking. And we're going to be continuing a discussion that we started in New Orleans about gold standard chapters and trying to help our chapters figure out how they can be the best they can be and provide the best value to their members. Because if you aren't having a good time in your local chapter, you're not going to get what Crew Network's about. So we're trying to make our chapter strong, allow them to attract and retain the best talent in the markets that they're in, and to give them the tools and resources to do that. And then there's the convention. In September 14th to 17th in December, welcome to the Power Center. Kind of a play on words. We think that we as women in commercial real estate are incredibly powerful, but absolutely being in DC, we're truly at the center of power. We're going to be at the Gaylord, which isn't in the district, but we're close enough, and you'll get all the energy of the district brought to your doorstep at the Gaylord. We've got some great speakers. Diane Swank, many of you have probably seen her on CNBC. Nora O'Donnell, who's also NBC News and CNBC. Linda Rabbit's going to be our speaker for our awards dinner on Thursday night. Sheila Johnson from right here in Tampa is going to be our opening speaker on Thursday morning. And for those of you who might have read Too Big to Fail, if you didn't read it, get it on your Kindle, because in a hardback, it's a huge book to lug around. It is an incredible read about everything that led up to and going through the fall of Lehman and everything else on Wall Street. And Andrew Ross Sorkin is really going to be a great speaker for us. We have a couple of potentially surprise guests that we're keeping our fingers crossed about, but I think it's going to be a great convention. We've got concurrent sessions, which are going to be talking about everything under the sun. Capital markets, what's going on in senior housing, what's going on in the multi-housing market for real, what's going on in the hotel market. Mini sessions are usually focused on something you can get your arms around in about 45 minutes to an hour, very focused, fairly small groups led by professionals in various disciplines in the industry. Workshops, leadership development workshops, professional development workshops, and the learning excursions in DC. There's so much going on in DC. There are going to be some great tours. So please mark your calendars to attend. Crew Tampa Bay always seems to sponsor a few members to come. I'm really looking forward to seeing a good group of you there. It's always great energy. 900 crew members and non-members all there looking to really know each other, learn, and have some fun. We really do have some fun. So step into the Power Center. We're all getting back to business, and I hope that you will join us there. And, you know, Crew Network, we're working for you as a member. I hope that we're doing a good job. If we're not, let me know. And I really do appreciate the invite here to talk to you at Crew Tampa. It's always good to see my friends here in Tampa, and thank you very much.